As you would know, we do not yet have the GDP data for the June quarter, but it will show the biggest economic contraction in many decades, likely to be around 7%. If there's any good news at all to be found here, it's that this decline is not as large as we initially feared. It's also not as large as what we're seeing in many other countries at the moment. Similarly, while the labour market outcomes have been very poor, they've not been as bad as was expected. Hours worked were initially expected to fall by a staggering 20% over the first half of this year. The actual fall has only been around half of this, largely due to Australia's initial success in containing the virus and the earlier than expected easing of some of the restrictions. Looking forward now, there's a high degree of uncertainty about the outlook, and our economic recovery depends upon how successful we are in containing the virus. In our baseline scenario, we're expecting the Australian economy to contract by around 6% this year, and then grow by 5% next year and 4% in 2022. It's certainly possible that we'll do better than this if there's a near-term success in containing the virus or there are medical breakthroughs. But on the other hand, if we were to see further setbacks in containing the virus, the recovery would be delayed even further. Given this uncertain outlook, we need to be prepared for a recovery that's uneven and that's bumpy. The recovery is also likely to be more drawn out than was initially expected, despite the downturn being less severe than expected. And there are a few factors at work here. The most obvious is the outbreak in Victoria. At a personal level, this is very distressing, and on behalf of the RBA, I extend very best wishes to everyone in Victoria. And on the economic front, we expect the outbreak will reduce GDP growth in the September quarter by at least 2 percentage points. This will broadly offset the recovery that's been taking place in most other parts of the country. And as a result, we are now not expecting a lift in economic growth until the December quarter. Another consideration is the growing impact of an extended period of weak aggregate demand. In the initial phase of the pandemic, some firms were able to keep going because they had a pipeline of work to keep them busy. And the construction industry is a good example of this. But with few contracts having been signed over recent months, this pipeline is now being emptied for many firms, and they're having to scale back and cut back jobs. Critical to reversing this is stronger growth in aggregate demand. A third consideration is that people's attitudes to spending are changing because of the pandemic. It's probable that households and businesses will remain more cautious than they were before, and this will affect both consumption and investment. How long this change might last is hard to tell, but we are unlikely to see a quick return to the previous patterns of spending. Given these considerations, our baseline forecast is that the unemployment rate continues to increase, reaching around 10% later in the year. The unemployment rate would have been substantially higher than this if it were not for the JobKeeper program and other income support programs. And if we take into account people who are on 0 hours, the true unemployment rate is higher than the published measure. We're expecting the published unemployment rate to decline gradually from its 10% peak, but to still be around 7% in a few years' time. And as I'll come back to later, addressing this high unemployment rate should be very high on our list of national priorities. In all three scenarios published in our latest update, inflation is likely to be very low. Inflation fell into negative territory in the June quarter for the first time since the early 1960s. While grocery prices and the price of some other items rose, this was more than offset by the decline in oil prices and government's decisions to make childcare free. We're expecting inflation to return to positive territory in this quarter, but to average between only 1 and 1.5% over the next few years. Wage growth is also expected to be low, averaging 1.5% over the next 2 years. So it's a pretty sobering outlook. I'd now like to turn to the economic policy response. As the pandemic evolved in the early days of March, it became clear that a very significant monetary and fiscal response would be required. By virtue of my role as Governor of the RBA, I've been able to see firsthand how this support's been put in place. What struck me from the outset was the very strong sense of common mission from our political leaders, our regulators, our banks and the RBA itself. And that common mission was to support the Australian economy through this difficult period. The level of cooperation and coordination was extraordinary, and there was a real Team Australia mindset. In my view, this reflects positively on both Australia's political system and our institutions, and we shouldn't forget that. From the outset, there was a very strong sense that we needed to build a bridge to the other side when the virus is contained. As things have turned out, that bridge has had to be longer and shorter than we might have hoped it would be necessary. Even so, it's been the right strategy. At some point, the virus will be contained, and those foundations that have made Australia such a prosperous country will still be there. We'll be better placed to build on those foundations if we've limited the damage to the fabric of our economy and to our society while we're battling the pandemic. In terms of the RBA's own response, that began with a cut in the cash rate at our regular meeting on the 3rd of March. The Reserve Bank Board then held an extraordinary meeting just 2 weeks later, where it decided on a comprehensive package that included a further reduction in the cash rate to 25 basis points, the introduction of a target on the 3-year Australian government bonds of 25 basis points, a term funding facility for the banking system on which funds can be provided for 3 years at 25 basis points, the continued use of our open market operations to make sure the financial system had a high level of liquidity, and the modification of the interest rate corridor system with the rate paid on exchange settlement balances set at 10 basis points rather than 0. This package is designed to keep funding costs low right across the country and support the provision of credit, especially to small and medium-sized businesses. To support these businesses, the Term Funding Facility provides banks with an additional $5 of low-cost funding for every extra dollar of credit extended to small and medium-sized businesses. Many other central banks have announced similar packages, although the Bank of Japan is the only other central bank with a yield target. In their case, they have a target for 10-year yields. In announcing our yield target for 3-year bonds, the bank indicated that we're prepared to buy bonds in the secondary market in whatever quantities were needed to achieve that target. To date, overall bond purchases have totalled around $55 billion, and most of these bonds were bought in March and April. These purchases have had the desired effect. They've lowered yields and they've eased market dislocation, which was apparent at the time. In the past week or so, we've again purchased bonds buying around $6 billion. We've done this following a few weeks in which the yield on 3-year bonds had been trading consistently a little above 25 basis points. The yield is now closer to 25 basis points, and we are committed to maintaining the target. In taking the decision in March to target the 3-year yield, the board considered the possibility of instead undertaking a regular program of bond purchases, say buying a set amount of bonds each week. This is what a number of other central banks have done. We chose the yield target for a couple of reasons. The first is that it's a more direct way of achieving our objective of low funding costs right across the country. A bond purchasing program would have also lowered bond yields, but it would have done this indirectly, and there would have been challenges in calibrating the required size of the purchases. Directly targeting a longer-term risk-free interest rate is also a natural extension of our target for the cash rate, which is the risk-free interest rate at the very start of the yield curve. The second reason is that this target reinforces the forward guidance regarding the cash rate. The board has clearly indicated that it will not increase the cash rate until progress is being made towards full employment, and it's confident that inflation will be sustainably within the 2 to 3% target range. Given the outlook I sketched earlier, these conditions are not likely to be met for at least 3 years. So it's highly likely that the cash rate will be at this level for some years, and having a target for 3-year yields of 25 basis points reinforces this message. So that was our rationale. We have not ruled out a separate bond buying program or other adjustments to the mid-March package, but for the time being, the board's view is that the best course of action is to continue with the current package. The board recognises that in the unique circumstances in which the country currently finds itself, the solutions to the challenges we face lie in areas other than monetary policy. Having said that, the mid-March package is providing material help right now, and it will continue to do so. Interest rates are lower than they've ever been before, and the financial system is flush with liquidity. Also helping is the fact that Australia's financial system is in good shape. We went into the pandemic with strong balance sheets and high levels of capital in the Australian banking system, and this means that our financial institutions are well placed to provide the credit that the economy will need in the recovery phase. One monetary policy option that has been the subject of recent discussion is the possibility of the RBA creating money to directly finance government spending, so-called MMT. For some, this offers the possibility of a free lunch. The harsh reality, though, is there's no free lunch. There's no magic pudding here, and there's no way of putting aside the government's budget constraint permanently. As I spoke about in a talk last month, it's certainly possible for a central bank to use monetary financing to affect when and how government spending is paid for. Depending upon how things are managed, it can be paid for through the inflation tax, by implicit taxes on the banking system, or by higher general taxes in the future. But it does have to be paid for at some point. I want to make it clear that monetary financing of the budget is not on the agenda in Australia. The separation of monetary policy and fiscal financing is part of Australia's strong institutional framework, and it served the country well and will continue to do so. The Australian government and the states and territories have ready access to the capital markets, and they can borrow at historically low rates of interest, and that's how they should finance themselves. At a more practical level, I'd like to mention a couple of other areas where the RBA has been providing assistance with Australia's COVID-19 response. The first is that as the transactional banker for the Australian government. Over recent months, the RBA's banking systems have been used to make record numbers of payments, processing the government's income support to households and to businesses. We've done this with around 90% of our staff working from home, and it's been a great effort by the RBA's banking and payments teams. The second is meeting the increased demand for banknotes. While COVID-19 has accelerated the shift to electronic payments, there has paradoxically also been record demand for banknotes. It seems this is because people want to hold a few more dollars at home. The result has been that the stock of banknotes on issue has increased from $83 billion in February to $94 billion today. That's a large increase in a short period of time. We've met this extra demand despite our main storage vault being located in one of the coronavirus hotspots in Melbourne. I'd like to close now with some general comments about the economic policy response to the pandemic. While monetary policy has played an important role, it's been fiscal policy that's provided much of the support to the Australian economy. This is quite a change from how things have worked over recent decades, and it's being accompanied by a significant increase in public borrowing as governments work to limit the hit to people's incomes. This shift in fiscal policy is quite a shock for a country that's got used to low budget deficits and low levels of public debt. In that context, it's worth making a few points. The first is that by borrowing today to support the economy, we are avoiding an even bigger loss of output and jobs that would damage our economy and our society for years to come, and this would also put ongoing strain on the budget. Second, Australia's public finances are in strong shape, and public debt here is much lower than in most other countries. Third, the overall national balance sheet is also in a strong position after decades of good economic performance. And fourth, government's financing costs have never been lower, with interest rates being the lowest since Federation. This all means that the expected increase in public debt is entirely manageable and it's affordable. It's the right thing to do to borrow today to help people, to keep them in jobs, and to boost public investment at a time when private investment is very weak. Of course, there'll always be debates about the precise nature of the programs and about how much support should be provided. But the general direction, the general strategy that we have right now is the right one. Looking forward, an important priority will be to boost jobs. Based on the forecast I discussed earlier, high unemployment is likely to be with us for some time. I think it should be a concern for us all. The Reserve Bank will do what it can with its policy instruments to support the journey back to full employment. Beyond that, government policies that support people's incomes, that add to aggregate demand through direct government spending, and that make it easier for firms to hire people, all have important roles to play. As I've said on a number of times before, we need to make sure that Australia is a great place for businesses to expand, to invest, to innovate, and to hire people.